well, the Australian dollar fell off a 10-month peak this morning after the US Federal Reserve Governor, Lael, Brainard, hinted at aggressive rate hikes in the US in the course of this year. That, of course, came after our own Reserve Bank yesterday opened the door to future rate hikes, ditching its long-held patience over macroeconomic settings. Now, for more analysis about the currencies, I'm joined by Matt Richardson, Senior Corporate Foreign Exchange Dealer at OFX. Matt, many thanks for your time. Really interesting to see those currencies spike immediately on that Reserve Bank statement yesterday, seeing, the dollar against the yen, against the pound, against the euro, all of them climb to those new sort of short-term peaks.
Yeah, absolutely. Certainly some really interesting price action that we saw in the wake of that policy update yesterday. As expected, the Reserve Bank held back on any interest rate adjustments yesterday, but it was that key and subtle change in that RBA rhetoric that came with the statement that followed, and that removal of patience in monitoring inflation pressures and broader macroeconomic performance in governing expectations for future rate hikes. And that's really, and the moves that we saw on the back of that really came from the market now pricing in a potential of a June rate hike. And with inflation numbers coming out at the end of this month, a robust read there could well bring that forward and perhaps into next month's meeting in May ahead of the federal election as well. So that pricing really now reflects, I guess, the narrowing in the yield differential or premium that the US dollar has enjoyed over the last few months. But as you mentioned in the lead in there, that correction we saw through the latter hours of the overnight session on the back of those comments from Fed Governor Brainard reflect the fact that the US will still be advancing interest rates at a quicker pace at this stage, as well as employing some balance sheet reduction there as well. So in terms of movements going forward, monetary policy and that differential across, not just against the US dollar, but against key crosses like the euro, like the pound, like the yen and the New Zealand dollar, will really be dependent on how the monetary policy platform evolves as we move through into the second part of this quarter and the second half of this year.
Okay, because one thing that we've noted for a long, long time here on the program is really the fact that you've got iron ore prices well above $100 US a tonne. You've got coal prices, metallurgical coal prices, steaming coal prices, really at all-time record highs. You've got the oil price above $100 US a barrel. The last time you had that consequence of events, you had the Australian dollar getting on close to $1.10. Now, the difference this time, the only difference this time that you can see is interest rates. That's the key, isn't it?
Yeah, and certainly we've seen commodity prices across the board and those rallies that we've seen across the last month, particularly exacerbated by the current events in Eastern Europe as well. So obviously iron ore price elevated on the back of changes from China and an extension in the period that they've given manufacturers to sort of shift processes toward greener technology. That's pushed the iron ore price up to record highs, but obviously gas prices as well through supply shortages and, of course, oil prices as well, elevated on the back of those global shortages. And that's really playing into the inflation picture as well. And the risk that we see at the moment, I think the caution that's perhaps plaguing markets somewhat in terms of interest rate expectations is that these inflation levels that we're seeing are supply driven, and the risk that central banks place in moving interest rates too quickly, and they add another handbrake to perhaps the recovery that we would have otherwise expected out of the pandemic that's now sort of going into year 3. So it is difficult for central banks to manage these inflation, record inflation numbers and global growth expectations while trying to raise interest rates as well. So it will certainly be very interesting to see the impacts on broader economic performance as interest rates do start to rise. And that will go a long way in shaping further performance across currency markets in the next 6 to 12 months.
Yeah, it's going to be fascinating to watch it, I'm going to say, Matt, because it clearly is one of those points where otherwise the currencies would be higher, but those interest rates, they're the key right now to their future direction. Matt Richardson with OFX, many thanks for your time here on the program today.